Hello everyone, welcome to Commerce Edge. I'm Rangjit, and in today's video, we'll learn about the introduction of partners account. Don't skip the video so that you will not miss anything that I will explain. And you can take notes if you want to, or you can just download these slides from the description. Let's get started. Let me just give you a brief explanation of partnership. When two or more people come together to start a business, it is called partnership. As you know that to start a business, the minimum number of partners is required is 2, and the maximum is maybe 10, 20 or 50. It depends on what type of business you will start. And remember this important points. The Indian Partnership Act was initiated in 1932. Now, when these partners run a business together, they invest money, share profits, and spend on business activities. To keep a record of all these activities of the partners, of how much profit or salary they get, we need an account. That is where that is why we prepare partners account. Let us move to the 10 important features of partners account. The first one is association of two or more persons. As I mentioned earlier, a partnership is formed when two or more persons come together, and the number of person depends on what type of business you started. It can be 10, 20, but the minimum is 2. The second one is agreement based. A partnership is formed through an agreement, and that agreement may be written or oral. This agreement is known as the partnership deed, which outline the terms like profit sharing ratio, capital contribution, and all the duties of the partners. Profit and loss sharing. Partners agree to share profit and losses of the business in a specific ratio mentioned in the partnership deed. If it if it's not mentioned in the partnership deed, then the profit and losses are shared equally among the partners. Unlimited liability. In a partnership, each partner has unlimited liability, which means that the personal assets of the partners can be used to repay the firm's debt if the firms are insufficient of the funds or assets. Mutual agency. Every partner acts as an agent and principal for the firm. This means that a partner can bind the firm and other partners through their actions. Business purpose. A partnership must be formed to carry a lawful business. Any association formed for a charitable or social purpose is not considered as partnership. Capital contribution. All these partners contribute capital to the firm, which may be not equal. This amount may be this amount or nature of contribution may be in cash, assets, or any requirement of the business, which are agreed among by all the partners. Separate entity. Though legally a partnership is not separate from its partner, for accounting purpose, the firm is treated as a separate entity. No perpetual existence. The partnership does not have perpetual existence, which means that it can be dissolved due to death, insolvency, retirement of partners, or mutual agreement among all the partners. And the last one is registration. Registration of a partnership firm is not compulsory under the Indian Partnership Act, but registered firms are important because they can enjoy uh, they can get legal benefits like the ability to file suit in court. There are two methods of preparing partners capital account. the fixed capital account, and the fluctuating capital account. In the fixed capital account, there are two types of account that are needed to prepare: the capital account and the current account. The capital account is used to record fixed capital contribution made by the partners. The capital balance remains constant unless there are changes such as additional contribution or withdrawal, which are very rare. The current account is prepared to record any transaction such as withdrawal, interest on capital, share of profit or loss, or any other adjustment related to the partner's day-to-day transaction with the business. The fluctuating capital account method involves recording all the transactions such as capital contribution, withdrawal, share of profit and loss, and every adjustment. I mean all the adjustment which is given in the question, which are directly in the partner's capital account. Let us move to the profit and loss appropriation account, or the preparation of profit and loss appropriation account. Before diving in this topic, we have to understand first, why do we prepare profit and loss account or profit and loss appropriation account? We prepare this account to show how the net profit is shared among the partners according to the partnership deed. It comes after profit and loss account, which means that we have to prepare the profit and loss account first. Then after getting the net profit and net loss from the profit and loss account, we transfer it to the profit and loss appropriation account, and and that account, which is the profit and loss appropriation account, shows all the or shows the overall profit or loss of the business. Remember that profit and loss account and profit and loss appropriation account are different accounts, not the same account. Let us see the important items present in the profit and loss appropriation account. The first one is the net profit as per profit and loss account, which is from the which is present on the credit side of this account. Net profit is the profit made by the business after all the expenses from the profit and loss account. And remember, students, whenever you write anything on the credit side, you have to write the word buy first, and whatever things you write in there or anything that you write in the debit side, you have to write the word to first. Like for example, on the debit side, buy net profit; on the debit side, to net loss. Let's move to the second item, which is present on the debit side of the profit and loss appropriation account: the interest on loan. When a partner gives loan to the firm pays them interest, and you know that interest is a reward. This interest is usually 6%, but it may be more than that or less than that. It depends on the business. To sal The next item again is from the debit side, and that is the salary or commission. Some partners may work in the business, and for their work they get a salary or commission. To transfer reserve, a part of the profit of a firm is kept aside as saving for future needs. This is called reserve. And the last item from the debit side is the net profit transfer to partners' capital account. After calculating all these accounts which I mentioned earlier, we will get the net profit or the net loss, and this not net profit net loss, we will get the profit or loss, and this profit or loss is transferred to the partner's capital account according to the ratio which is present in their partnership deed. And the last item from the credit side is the interest on drawing. If a partner withdraw money from the firm charge interest on that. It is the opposite of what of the second of the interest on loan. That's it guys for today's lessons. If you found this video helpful, make sure to like, share it with your friends, and subscribe to Commerce Edge. Thanks for watching, and I'll see you again in the next video.